Welcome to Bloomberg Markets. I'm Vonnie Quinn. U.S. stocks just hitting session lows now on this day before Thanksgiving. No record today, it seems. Investors also chewing on data that support recent comments from the Fed that there's no rush to cut rates further. Let's get a quick check on those markets now. As you can see, the S&P 500 down about 0.5%. It's been quite a volatile or choppy session, at least. The Nasdaq down 1.25%. That SOX index, all of the components in it are lower right now. We are seeing some money come out of treasuries. The data today was fairly benevolent. We're going to speak about all of it in just a moment. And then crude, about 0.5% off. The market obviously weighing the OPEC Plus meeting with some maybe lessened geopolitical tensions in the Middle East. Now let's get to some of those midday movers on the equity side. Bloomberg's Abigail Doolittle joins. Abigail.
Vonnie, investors not liking a slowdown in personal computers. You can see the shares of Dell Technologies down 12.3%. They put up a quarter where they beat earnings, but sales missed by about 1%. Also sliding growth on a year-over-year basis by about 1% for revenues of about $12.1 billion. Really weighing on the shares of HP as well, that recovery expected in PCs, personal computers. Well, the CFO of Dell saying that it's stretching into next year. Dell having its worst day since May 31st. Turning to one stock, though, that is soaring, Urban Outfitters. This stock is up the most since 2023, at the highs, up the most since 2020. They put up a big beat for both earnings and sales. Same-store sales up 1.5% versus the estimate of up 1.3%. There's probably a big bearish short squeeze here, though. There's an 8% short interest. And then let's take a look at the shares of Symbotic, the worst day since June of 2022. You can see a massive plunge here, down 38%. The automation technology company, supply chains and the like, well, they cut their outlook due to an accounting error. They're also unable to file the 10K, something that clearly investors don't like. And then finally, Vonnie, we have a high name IPO to take a look at. Let's take a look at the ADR Pony. The market cap up the last time moments ago, up about 20%. The AI driverless vehicle tech company, the IPO price of $13. It was pushed back from last week because of the high demand. And here you can see Pony AI, a market cap of $3.6 billion. And again, Vonnie, up, I believe, more than 15% at this point.
Yeah, really interesting moves there because it gapped higher at the open, Abigail, and it does seem to be deteriorating slightly. So any retail investors who have got involved might need to keep an eye on that stock. Now to the economy, as we had a wave of U.S. economic data released this morning due to the shortened holiday week. It included fresh PCE numbers, which showed underlying inflation accelerating in October. Earlier on Bloomberg, Stifel's Lindsay Piegza gave her take on what the data will mean for the Federal Reserve.
Has not yet continued on this disinflationary trend back to 2%. So the risks do appear to be leaning in the direction of stay focused on inflation, keep that focus, and take a more tempered and patient approach to additional policy easing, as clearly this is not an ailing economy in need of policy support. As we look out to 2025, yes, I do think the Fed is very much on the verge of a policy pause sooner than later.
Joining us now to dig into the latest reads on the U.S. economy is Kathy Bostjancic, Chief Economist at Nationwide Mutual. Kathy, thank you so much for joining. Part of the strength in today's data, the inflation data, is expectations for stock prices. I just want to show you this chart on the Bloomberg, which shows that goes out into the future, right? People are expecting stock prices higher next year, and that's being confirmed by some of the new targets that we have. How concerned does the Fed need to be by today's inflation data?
Well, hi, Vonnie. Always happy to be with you. I don't think it's overly concerning at this point. It's a tougher decision if they're going to cut rates again next month. I think it is a closer call, but I still think the data was encouraging enough that they could go ahead, cut rates another 25 basis points. Particularly, if you look at the headline inflation number, it was only up 0.2. Lower gasoline prices helping a lot there, and as you noted, oil prices have another leg down because of lessening of tensions in the Middle East. So really, you have to remember they target the headline inflation. That said, there is inflation that's sticky at the core level, particularly in services. But when you look through it, you mentioned equity prices. Part of the reason that the core service prices are up so much is because people are paying more commission charges to asset managers and fees, and that's really simply just an artifact of stock prices being up. That's not really inherently inflationary. So I think there's more room for them to cut rates, but I do agree that, come January, they probably pause. Then they're going to assess what are we getting out of the new administration in terms of trade, tariffs, immigration, and then what does the landscape look like then? But my sense is, it's not a slam dunk, but that they can get another rate cut in next month.
So Deutsche Bank out with a note today entitled Terrified, which I thought was, a good way to describe it, because as you say, they might start pausing in January because the outlook is so uncertain. Is it possible for the Fed, though, maybe to overcompensate, to get in another cut before we get these tariffs, in the books?
Yeah, I mean, there's so much uncertainty on the tariff front, right? We know, of course, the announcement that Donald Trump, made through social media, but is that a negotiating tactic? Is it reality? We've seen this game book play out before, and yes, there were some tariff increases and notable ones, particularly, vis-a-vis China. But we never saw the large tariff increases against China, Canada, or Mexico, or European autos. There were threats, but it never came through. But we'll have to wait and see. Now, certainly, if you get large across the scale tariff increases, that certainly can boost inflation. Depends whether it's at the wholesale level or the consumer level. But it also reduces growth. So I think the Fed is aware of that, too. It'd have a negative impact on consumer spending. So, they have to wait and see. I think it's just premature at this point to speculate. And it probably makes sense that they wait. Now, could they do another rate cut in January? Possibly, although they have also told us they'd like to slow the pace of rate cuts down. So to me, it also makes sense. January seems the optimal time to kind of pause and wait and see.
Yeah, it's fascinating. Markets really just looking at 2 to 3 Fed cuts priced in for all of next year. But let's talk a little more about personal spending. It came in today through October on target at about positive 0.4%. How strong is this consumer, given that we're seeing all sorts of mixed data out of retail earnings, for example, Kohl's, Macy's, some of the department stores that sort of are grab-alls for the consumer, much, much lower. They didn't perform so well, and obviously some individual brands did.
Yeah, that's correct. I think what you're seeing is a consumer that's becoming, increasingly more price conscious. They were price aware before. Previously, we all felt the impact of inflation, but they're being very choosy now and what they spend their money on. And we're seeing that. In fact, it was a notable change that in October, we actually saw the personal savings rate rise 0.3%. What we have typically been seeing is the savings rate goes down month after month because consumers are spending more than their income gains. So what we're seeing is a alignment or realignment back into what is typically a fundamental situation where consumers spend in line with income. We've seen this big drawdown. That said, with the revisions that we saw going back to April, the savings rate and income gains are actually less than we thought. So now the savings rate for the month of September was revised down 0.5%. So, the consumer's in a little bit of a tighter spot now. I think they'll continue to spend as long as employment and wage gains prop up income. If you see, employment gains start to falter, I think the consumer's going to have a harder time.
What is this due to, the consumer being in a tighter spot? Because you say we're not seeing that much weakness in the labour market. We're not seeing that much weakness in wage data. We're seeing the Fed cut rates, so technically there should be some kind of trickle-down effect. So what is causing this consumer realignment?
Well, I think if your upper middle income and upper income households, you're feeling quite positive right now on the economy and your own situation, right? You mentioned equity prices are up a lot, so that feeds into a wealth effect. Home prices, even though the gains are slowing, there's still tremendous gains there on overall asset prices. So asset holders, upper income households feeling good, and they're also garnering good wage gains. Where you see in the lower middle income, lower income households, the price levels are really weighing on them. And interest rates have come down, but they're still very high. And when you look at employment, the concentration is quite remarkable. It's really coming in government and leisure and hospitality and healthcare. Other private, if you look at the private sectors that are more cyclical, you're not seeing wage gains or employment gains either. what you're seeing is companies aren't laying off workers, but they're also not hiring in a big way.
Kathy, thank you so much, as always, for your time. That's Kathy Bostjancic, Chief Economist at Nationwide Mutual. And speaking of PCE and inflation, US turkey prices are dropping even at a time when supplies have grown tighter. It's still a little too early for data to show consumer purchases for this complete holiday season, but sales volumes of whole turkeys were down about 20% from a year ago in the 4-week period ending November 4th. Experts are pointing to slumping production figures as a good proxy for slumping demand. Turkey prices and the number of birds raised are down 6%, sending production to the lowest since 1985. Coming up, holidays right around the corner, but here at Bloomberg, it is still earnings season. Autodesk President and CEO Andrew Anagnost joins us next. We'll dig in on the company's fresh earnings report. This is Bloomberg. This is Bloomberg Markets. I'm Vonnie Quinn. Time now for the stock of the hour. Autodesk reporting third quarter results that largely topped analyst estimates, but missing estimates for one metric, adjusted operating margin. The company also announcing a new CFO this week. Joining us now to discuss all of this and more, we're joined by the company's president and CEO, Andrew Anagnost. Andrew, thank you so much for joining. So as I was saying, many metrics beat. You did, however, come in slightly shy on the operating margin. Stock was at an all-time high, down more than 8% today. Is this market being fair to you?
Yeah, so first off, we had a great quarter in a tough climate. We beat on all key metrics, and we raised the midpoint of the guide for the year on all key metrics. You know, really completed our 8th quarter of beating expectations in the market in a really challenging time. And this is happening because of people really needing the digital solutions that we need and how we deliver things from design to make. More importantly, we also delivered really strong, consistent performance in the make side of our business, construction, manufacturing, production. These areas of the business were growing north of 20%. And that's another testimony to things. Is with regards to the margin in the quarter, that's just because our annual user conference, Autodesk University, moved into Q3 this year and is usually in Q4. All of that washes out in the full year results.
So that will increase, you're saying?
Yeah, the full year guide for our operating margin is in line with where people expect. We actually raised the lower end of the guide there.
You announced a new CFO to begin work next month. Why?
Well, we remember we were in an interim CFO period with Betsy Balfell sitting in as interim CFO. And what we're focused on right now moving forward is we're focused on operational excellence inside our finance organization. You know, we have some great guidance and communication processes within our core finance organization, but we are very much focused on sales and marketing optimization moving forward. And we want best-in-class operational excellence in our finance organization that will help us drive those optimizations, make sure that we're getting a return for every dollar, and hold people in the company accountable. And that's why we've hired Janesh into the role, because he's the kind of person that focuses on the operational excellence inside the company.
Talk to us about conversations with Starboard. Have you had any ones in recent days? Are they asking for more?
You know, we listen to all of our investors, and the thing, I want to focus on is the thing we agree about. And the thing that we all agree about is Autodesk needs to drive more optimization in its sales and marketing functions. The work we've done over the last 2 years is delivering the free cash flow buildup you're seeing now. It's delivering the revenue performance you're seeing now, and it's also delivering the reaffirmed cash flow that we gave, the $2.05 billion we gave for next year. That's all a result of 2 years of hard work. But the result of that work is allowing us to now look at our sales and marketing expenses and optimize how we go to market. And that's something that we and all the investment community agree on is an important target for Autodesk, and it's an important focus for us.
Starboard had been asking for a new CEO. Obviously, difficult to talk to you about this, but have you considered looking at a successor, potentially stepping aside yourself?
We think we have the right strategy, and look at the results we're delivering, okay? 8 quarters of beating the company's expectations, two years of preparing for the results we're delivering now. We're heading into a free cash flow buildup. We're through the trough of our free cash flow. We're delivering on exactly what we said we were going to do 2 years ago. In fact, we're beating them on an apples-to-apples basis. Our non-GAAP margins are ahead of what we said we were going to do 2 years ago. We're actually achieving next year's targets in this year on an apples-and-apples basis, and there's more to come. So I believe in our strategy. I believe we've got excellent execution, and I believe we have a really bright future moving forward.
You announced increased margins and buybacks, obviously, as well. Was this a direct response to Starboard's asks?
Our capital allocation strategy didn't change. Our first goal is to invest in the business, then to offset dilution. And our third goal is to opportunistically buy back ahead of dilution. Now, we're in a period of building up free cash flow. We've exited the free cash flow trough, and our free cash flow is building. So we issued a new repurchase authorization because we want to have the room in the medium and long term to execute on that strategy. And that's what that's all about. It's really consistently executing on the strategy we have and making sure we have the headroom to do that.
Andrew, thank you so much. We only have just a few seconds left, but can you tell me, are you still engaged in ongoing conversations with Starboard?
We talk to all of our investors all the time. And what we do is we focus on what's important to them, which is delivering results and moving forward, delivering margin accretion through sales and marketing optimization.
Got it. Andrew, thank you so much. Much appreciate your time. That was Andrew Anagnost, who is CEO of Autodesk. Coming up, it's not just a toy anymore. The expanding Elf on the Shelf universe enters another holiday season bigger than ever. A closer look at Elf on the Shelf maker, the Lumistella company, with co-founder and co-CEO Christa Pitts. That's next. This is Bloomberg. This is Bloomberg Markets. I'm Vonnie Quinn. You might recognize the now famous Elf on the Shelf, but the brand is gearing up for a new holiday season with a cornucopia of products and projects. It's a vast world now compared to that single elf that started it all almost 20 years ago. Joining us with more is Christa Pitts, co-founder and co-CEO of the Lumistella company, makers of the Elf on the Shelf. You're in 25 countries around the world now, and it's an expanding universe. You control the IP these days. So how do you go about building out the Elf on the Shelf brand and going into more products, collaborations, networks?
Yeah, what we realized is that not every product that we offer, Elf Pets, Elf Mates, Nora, who is a new key character, a balloon in the Macy's Thanksgiving Day Parade, is not necessarily the elf on the shelf, right? The elf works for Santa, reports to him, comes back to your home, and flies back and forth from the North Pole. But in the case of the ever-broadening world we're creating, the IP, as you've pointed out, we needed a new name, a caretaker. And that's where the Santaverse comes from. So we've launched the Santaverse, and underneath the Santaverse, all of our products, all of our brands can live in harmony.
Do you work in countries where there isn't a Christmas per se, or does it have to be a country that's predominantly Christian in some way?
Yeah, we are in over 25 different countries. And of course, every country celebrates the Christmas season in a different way, which we recognize and we appreciate. And some countries have Boxing Day or Three Kings Day. And so there are variations based on the country in which you live. But ultimately, the magic and the belief of the season is what our company represents. We create joyful family moments. And I think people love that.
Give us a little insight, or as much as you can, into things like revenue and, what's a better deal for you in terms of margins? Is it getting something into a grocery store, or is it getting a movie made, or is it creating a new type of doll?
Yeah, so we break our business into a few different components. We've got entertainment, experiences, and then consumer products. And so we're able to really broaden the net that we are serving our consumers within. So if it's entertainment they're craving or content, we have music videos that are on YouTube. We've got a multitude of partnerships, including Netflix. So we have some real beautiful things already on there, but also in the pipeline.
And what kind of percentage do you take, for example, and what kind of percentage do the creators have to take for something like what you've got on Netflix?
Yeah, it really depends on the deal. You know, we're very fortunate in that my sister, who is our co-CEO and co-founder, is really the hub of creative content. So nearly all of the content that we put out and have produced thus far is made based on an in-house expertise. That's the books, that's the consumer product part of what we do, and it's also our content. Much of it is created by Santa, of course, but ultimately through our
Santa's
own pipeline.
elves,
Yes.
really.
Yes.
Speaking of Santa's elves, how much do you have to think about the possibility of tariffs next year? Because, yeah, you may not be the actual manufacturers of some of these products, but somebody is manufacturing them.
Actually, we are. So we do the production sourcing ourselves, and so it's a very real consideration for us. You know, obviously there's still a lot to be seen, as we've been hearing from Bloomberg today, but we realize that free trade is important and that is going to serve everyone, but it has implications, especially if you are a small to medium-sized business. As we do, sourcing, production, and the entire supply chain pipeline, it has real effects, both in what we are receiving into the country and what we are putting into other countries.
So this little elf, for example, who is pretending not to stare at me, but is obviously taking notes, how much does he cost to make, and how much does he or she go to the consumer for, and how will that change next year?
Yeah, so we don't talk as much about the price on that side, but we do talk about the fact that it is about $29.95, and it ranges up to $32.95 depending on the retailer that's carrying it. And what we're really spending our time focused on is the safety of products. You know, when we talk about the trade situation and we talk about potential tariffs, one of the things we're most focused on is compliance.
Well, Christa, I hope that you come back and give us an update. Of course, after all the notes have been taken. That is Christa Pitts, co-founder and co-CEO of the Lumistella company, makers of the elf on the shelf. And she's probably headed back to the North Pole herself as well after the Thanksgiving Day parade. That does it for Bloomberg Markets. Happy Thanksgiving.